Florida morning, and we haven't had this kind of weather for a little while, so this is really appreciated. Really appreciated. We are live streaming this and recording this, so we have another audience that's removed from the building. But I welcome all of you as well. So we're ready to get started now. I'd like to talk to you a little bit about who AMAC is. We are the AMAC Foundation, but we're part of the growing AMAC family. And let me talk a little bit about the AMAC companies. AMAC Incorporated is the Association of Mature American Citizens. It's a relatively new organization formed in 2007, so it's about 15 years old, I guess, roughly. Growing rapidly. We have 2.4 million members at AMAC, and it's just continuing to grow. AMAC is the largest senior conservative advocacy organization in the country and continuing to grow rapidly, as I said. AMAC is the organization that represents seniors in Washington, making certain that AMAC members' viewpoints get communicated to lawmakers so that Social Security, as an example, concerns that seniors have get communicated appropriately to lawmakers. And AMAC is actually a membership organization. You really join AMAC for two reasons. One is the membership benefits. Secondly is to gain an avenue of advocacy for your senior position. The advocacy actually takes place as a result of AMAC Action, which is AMAC's, I guess feet in the street would be a good word to describe it. They are the people that advocate directly with elected officials, take viewpoints from members and convey them to lawmakers, and basically make sure that lawmakers understand what's important to seniors. That's what AMAC Action does. The AMAC Foundation, the organization that I represent and my colleagues, who you'll hear from shortly, we are AMAC's public benefit corporation would be the correct term. We are a 501c3 public charity formed in 2013, but 2014 was actually our first year of operation as a foundation. And basically, we serve America's seniors. That's all that we do. Our mission, you can read our mission, help protect and ensure the financial security, health, and social lives of current and future mature Americans, and to help Americans navigate the bewildering array of decisions that they need to make. That second part of that mission is really what our Social Security Advisory Service is all about, and I'll talk a little bit more about that. But we shorten the mission to what we have up in our logo, supporting and educating America's seniors. That's what we do as an organization. And I'll tell you how we do that. The foundation conducts a lot of seminars. We average, last year we did 30 seminars in total. So two to three every month that we do on topics that are important to seniors. Social Security, certainly. Aging into Medicare is one that we typically do. But we do a lot of general subject seminars on health-related issues. We even do some technical sessions from time to time. Like one of our most popular sessions historically has been cutting the cord with your cable company. Interesting story there. We were doing a seminar, and at the conclusion of the seminar, I typically ask for ideas for future subjects, and a woman in the front row said, "I wish they could tell me how to get rid of my cable company." So there was a lot of head nodding on that. So I said, that sounds like that might be an interesting topic. So we ran a series of those seminars that they were great. We had like 100 people at every one of those. So there's not a lot of love for the cable companies. But that's one thing that we do, public seminars on issues that are important to seniors. We publish a lot of material relevant to, again, topics important to seniors. Every week on our website, we publish a blog article. We pick an article that's important to seniors and do an article about it. Some of those are guest posts. Some of those are posts that we've written ourselves. So we keep a lot of information moving on behalf of seniors. Certainly a lot about Social Security and Medicare as well. So we do a lot of publications. Whoops. We also operate two topically dedicated websites, I would say, Social Security Report and Medicare Report. Those websites are updated every day, 5 days a week, and basically they channel information about those two subjects. The Social Security Report, for example, was built many years ago really as an aid for congressional aides, a tool for congressional aides to keep them appraised of what's going to happen or what's happening with Social Security, new legislation, new developments, new reports, whatever. But it's kind of evolved into a general purpose repository of information about Social Security. And same thing with Medicare. It's just a repository of information that we just keep people current on those topics. And as I said, we update those 5 days a week. We also have recently gotten very active in support of the veterans community. AMAC has historically been very active in support of veterans. AMAC has about 2.4 million members, and 31% of those identify as veterans. And also of that 2.4 million, 3/4 of those members indicate that there's someone in their family structure that's a veteran. So veterans issues have been very important to AMAC from the very beginning. But about 2 years ago, we took that up another notch and created something called the AMAC Veterans 2021 Initiative, and we've been expanding that ever since. We're working with VSOs, veteran service organizations, on collaboration issues, working with them on legislative bills that affect seniors, and so we're very, very active. Our website has a page called For Veterans, which is a searchable database of programs and reference sources, basically things that are important to seniors that they can interrogate the database and find out how to contact people to get more information and that sort of thing. So we're very active these days in the veteran community, and that's become a foundation priority. We also operate our highly accredited Social Security Advisory Service. That's our folks that are here today, and we'll talk more about that as we go. But we formed the advisory service back in 2016, and it's been growing tremendously. And I'll talk a little bit more about that as we get into this. And also, we have just decided to branch out with our Social Security Advisory Service, and we implemented something called the concierge program, where we actually go out into companies, into private companies that don't have resources that understand Social Security, and we explain Social Security to their employees, and then we stay on site and handle their questions. So that's kind of a new service. We're just getting started on it, but it's going very well. So that's a very quick overview of what the foundation does. Our primary website, amacfoundation.org, I would suggest you take a look at that when you get a chance. Has a lot of valuable information. Anytime we do a seminar, we post the event schedule on there and a description of the seminar and instructions on how to register. We have a lot of information on there, as I said, on veterans issues. We also have a couple of pages, one called audio files and one called video files, where, like this session today is being video recorded, and next week that'll be put up on the website for on-demand access. The audio files are, well, I'll get to that in a minute. We also have a resources page that has a lot of general information that's applicable to seniors. And then finally, our news and interesting information, we call it, which is really our blog page, where that's every Monday morning at 9 o'clock, a new article appears on there on a topic that's important to seniors. So that's our foundation website. The advisory service. I mentioned we started that in 2016. 2016 was kind of a startup year. We had 4 initial advisors who were trained and accredited by the National Social Security Association, and we kind of took our time getting started. But the whole advisory service came out of a concern that our founder, the late Dan Weber, had, that seniors don't have a good place to go to get credible information about Social Security. As they're aging into the program, there's no real place to go. to get an understanding of how the rules affect them, I guess is the right way to say that. So he felt very strongly that we should have a service that handles that. And so we had an initial complement of 4 people that were trained and accredited. And then 2016 was our startup year, and we didn't really go public too much with it the first year. But then in the following year, 2017, we realized this is really going to work. So we started to publicize it more, and that graph shows you how we've grown from 2016 up to the end of 2021, 6 years of operation. And the red arrow there that you see basically is to indicate that in November of 2021, we hit our 20,000 mark, where we completed the 20,000th counseling session, as we call them, with somebody that needed information. We're still growing. We're growing at the rate of between 500 and 600 a month, so we're now well up over 21,000, and it's just going to continue to grow. We now have 7 advisors, and so we keep an eye on the volume, and we expand as necessary, but it's a service that just, our founder was right. People need this, and the track record that we build, I think, substantiates that. So we are proud of the advisory service, and it's humming along quite well. Just a quick recap of the numbers. Again, launched in 2016. We now have 7 advisors, and we're averaging 550 to 600 inquiries every month. The inquiries can be telephone calls, they can be emails, or they can be walk-ins for those of you that are local. So that's just a quick overview of the advisory service. I mentioned 2017 was when we began to really publicize it a little bit more. And one of the first avenues we took to publicize that was something called our Ask Rusty series. And that is a series where we take a question that we've received and we document the question, and then we do a complete answer to the question, a well-researched answer, and we publish that. We publish that to over 7,000 media outlets across the country. We publish it in print form and also in audio form for radio stations to pick up. And it's just, I think it's the thing that really caused us to grow. We published a compendium of those. What was the first year we published that? I think that was in 2017. 2018, we published just a compendium of questions and answers, and then 2019. Then in 2020, we took that another step, and we did the booklet that you have in front of you. And it's just a way for us to put more information in the hands of people that really need it. So I am pleased to tell you that we actually have Rusty with us here today. I will ask him to take a bow. Yeah. He takes a lot of joshing about being rusty, but that's our Ask Rusty, and that has really, as I said, caused us to grow and kind of put us on the map as a service.
Notice I get more rusty as I age.
Yeah, I'm not gonna. That's too easy. I'm gonna let that one go. The advisory service, again, we started it in 2016, but 2021 is when we implemented the concierge program that I've been talking about. And I personally view that as a substantial portion of the future for our service as we grow, going out into companies. There are very, very few companies that have HR people on staff that understand Social Security. It's a sad statement, but I believe it's a fact. And so we offer a service, we'll come on premises and we will explain Social Security. And we've done that now twice, and it works out very, very well. We do a complete seminar on what the program, how Social Security works, really, because we are constantly astounded when we find out what people really don't know that they need to know. So, we go on premises and then we stay as long as it takes to answer questions. So I really think that's a big part of our future as an advisory service. We're also implementing, actually starting next week, something called the Social Security Instant Academy, where we will put, first of all, on our Facebook page and then on our website, 1 to 2 minute snippets about little aspects of Social Security, basically in the form of an answer to a question. For example, the question might be, did you know you can file for benefits at age 62 and continue to work? And so we will answer that in 1 to 2 minutes that, yes, you can, but there are some things you need to understand if you elect to do that, and we'll cover that in 1 to 2 minutes. So again, it's just part of getting the word out about who we are and what we do. So that's going to start next week. So you can look for that on our Facebook page and also on our foundation website on that audios page. So that's just some of the things that are on the drawing boards and happening at the foundation. Now here's what we're going to talk about today. We're going to talk about what's new for this year, 2022. There are some things that change every year, limitations and thresholds and things like that. So we'll cover all that. The basics, how you qualify for Social Security, something that people are kind of vague on. So we're going to talk about that. When to file. One of the most frequent questions we get from people is, I'm turning 62 this year, should I file for benefits? And invariably, every question we get, we start the answer the same way. Well, it depends, you know, and then we talk. And so it really is situational. Everything is situational in Social Security, and that's why there are no simple answers to most questions. We're going to talk about a very popular topic for a lot of people, the taxation of their Social Security benefits. Unfortunately, for a lot of people, that's a surprise. First time they file their income tax return after beginning retirement benefits. It's not a pleasant surprise. So, you know, we talk to make sure people understand how that works. We'll talk about disability. We'll talk about spousal benefits, which is an area that we deal with quite frequently with questions about what benefits is my spouse eligible for. We'll talk about survivor benefits, same thing. Working after filing is another area we're going to talk about. My Instant Academy question of, I'm 62, I'm going to draw benefits, but I'm going to stay working. So what does that mean? How does that impact me? We'll talk about that. We'll talk about this thing called COLA, cost of living adjustments. Of course, those of you that are on Social Security know that you got a tremendous 5.9% adjustment, which is nice, except that inflation is 7.5%. So we'll talk a little bit about how that's calculated and the history behind it. And then something that we won't go into in a great level of detail because it's very, very complicated, the windfall elimination provision of Social Security and the government pension offset provision. You know, we'll take questions about that, but we won't cover it in detail. And then Medicare basics. We have in our complement of advisors a Medicare expert. So we will handle any questions you have about Medicare. We'll talk about the Medicare, the intersection of Social Security and Medicare. So that's what we're going to cover today. And so with that, I'm going to turn the clicker over to Ken. There you go.
Which is the advance here.
That's forward, that's backward.
Okay.
Yep. You don't want to do that.
Thank you, Jerry. My name's Ken Barron. I'm one of the foundation advisors. I think I'm the freshman of the group. Came in, a little less than a year and a half ago, and I'm most grateful to be part of this foundation and this great bunch of people to be working with. So I want to share a little bit of information with you about some of the new changes for 2022. Of course, Jerry just touched upon the new COLA, and I'm not talking about the stuff you drink. So the cost of living adjustment, sometimes I wish that we could just drink it and make it go away, because there were years that it was very scant, that's for sure. So this past year, because of the National Average Wage Index, it did determine, and this is usually always determined after the third quarter of every year, and that's why you never hear about what's the new COLA going to be for the following year. It's determined after that third quarter is over with. So it starts with the last quarter of one year, it goes on until the third quarter of the following year, and that's when this National Average Wage Index is determined, and that's how they came out with the 5.9%. So what did that mean? Well, it meant that those who are receiving Social Security benefits, you got a bump in your benefits. What does that mean for some who also have Medicare coverage and have to pay a Part B premium? A lot of the bump took care of that increase of the Medicare premium this year. We can certainly talk about that as we go along. And by the way, I just want to mention that if you have questions as we go along, if it is a kind of generalized question, please feel free to ask. Raise your hand. I'll acknowledge you. If it's more of a personal type of question that just relates to kind of you, let's address it after the session. We'd be glad to get together with you in the back of the room in private and discuss, okay? So, the COLA, what did that mean to a lot of people in this country? Well, it meant that you could, your taxable Social Security income went up from, as you can see, from 2021 up to this year's $147,000. What does that mean? That means that $147,000 of your earned income, whether it's wages or net profit from self-employment, that's the maximum you pay Social Security taxes on. And that's what goes on to your Social Security earnings record to be later used to compute your Social Security benefit, okay? Now, Medicare taxes continue, even though you've hit $147,000. It is kind of one of those indefinite kind of things. You continue paying Medicare taxes. The maximum Social Security benefit at 70. Why 70? Depending on your full retirement age, that determines your 100%, and that's determined by the year of your birth, okay? That 100% can also continue getting larger. And it is referred to delayed retirement credits after your full retirement age. So if you are not collecting benefits, beginning with the month of your, as we call it here, the FRA, okay, full retirement age. Beginning with that month up until the month you turn 70, you continue accruing a delayed retirement credit. Some people, and that's on a monthly basis. So if you decide to retire at age 68 and 10 months, okay, and that's when you want your checks to start, you haven't received any checks prior to that, then Social Security will add a delayed retirement credit for each and every month after your full retirement age. That increases your benefit. Now, some folks are getting up to 8% per year for each 12 months that you delay. There's an additional 12 months or 8% that's being added to your Social Security. So some folks at age 70 are getting not just 100%, but they're getting 132% of benefits. Why is that so important? In the grand scheme of things, if you're doing some future planning, you're a married couple, you want to leave kind of a legacy to your spouse. Some folks will delay applying for their benefits until age 70 because that person, if they should predecease their spouse, that spouse can collect that 132% for the rest of their life. Their own, whatever they're receiving, a spousal or under their own record drops, they continue getting the 132%, okay? Very important for a lot of folks because it is a lifetime benefit. I was privy a number of years ago, so I worked with the Social Security Administration for 34 years, folks. Okay, I'm a retiree. And one of my projects during my career was doing what is called the Centenarian Project. What is that? I was assigned a project, the task of going out and visiting folks who were 100 years old and over to make sure, number one, are they still alive? Are they still amongst us? I uncovered some interesting things, but that's another chapter in my book. The biggest thing that I remember hearing from some of our centenarians is that, when's my check going to end? Very sad. It's very sad. The best thing is that it doesn't. It ends when you pass away. That's when it ends, okay? So my message to them was always a very positive one in many respects, because I was told stories by them of how their pensions had died, their investments were gone, they were had to live with family because they had no more money to take care of themselves. But they were still getting a Social Security check, and they continued doing so. Okay, so this maximum Social Security benefit at age 70, coming back to this, for 2022, if you have always paid into the Social Security system the maximum amount of income in your career, that is probably what you're going to receive this year if you retire at full retirement age. And further on at age 70 and accumulate those delayed retirement credits, you'd be getting over $4,100 a month. But you have to wait to get that, okay? Now, quarters of coverage, how is that important? That's how you become insured. If you have life insurance, car insurance, you have to pay a premium. Those are your premiums that you pay to Social Security in order to qualify. That basically comes out to about 10 years of work under Social Security in your lifetime. 10 years in your lifetime to be covered for Social Security retirement benefits. The way you earn those credits this year is that for every $1,510 of income or net profit from self-employment, you earn a credit by paying taxes on $1,510. You earn a maximum of 4 credits a year. That's it. Whether you've earned $147,000 or $6,040. $6,040 in 2022 guarantees you your 4 credits. Okay? That's how you become insured. You need 40 credits in your lifetime. It doesn't have to be consecutive. It can be spotty at best. You start working, you stop, you did this, you did that, whatever. You may have started a business, had no profit in some years. Okay, so you had no profit, but the following year you had a big profit, and now you earn your 4 credits again. So now that's adding to your 40 credits. Let's move on. This, folks, right here, I can tell you from my career at Social Security, the earnings test is, and I love the word in our mission statement, Jerry, bewildering. And that's putting it mildly, bewildering. There are people in Social Security who don't understand the earnings test, and I was continuously being interrupted at times at my desk with some of the folks coming to me saying, explain this to me again, okay, because it can be complicated. So if you don't get it, you're not alone, okay? What does this mean? That means that if you are under your full retirement age, that's what the FRA stands for again, full retirement age. If you're under FRA, you can earn up to, this year, $19,560 and be guaranteed to receive all your Social Security checks. If you expect, and I'm saying if you expect, don't wait until you've earned it. You have to let Social Security know ahead of time. Provide them with a work estimate ahead of time. Because if you plan on earning over the $19,560, they need to know this so they can withhold $1 of your Social Security check for every $2 you're earning over that limit. This is how this works. It's a 1-for-2 withholding. You forfeit those dollars. So depending on how much you're going to surpass that 19,560, that is going to determine how many checks a person receives in the current year. So if Social Security needs to hold back 1, 2, 3, 4 months of checks, they'll do that at the very start of the year. Then they'll reinstate your checks later on in the year, okay? Now, again, if you're affected by this, you think you're going to be affected, or you have questions about this, if it's a general question, feel free to ask me. If it's not, it's more personal, we'll tackle that later, all right? I'm covering it very quickly because we could spend hours on just that topic alone, believe me, okay? The $1,630 you see there per month, that applies usually in the very first year a person retires from work. And I'm talking retire. It could be stopping work altogether, or it could be cutting down, all right? So let's say you've cut down on work. You're going to earn over 19,560. Let's say maybe 30,000. You were earning 60, now you're going to earn 30,000 this year. But you are going to have months of work that will give you maybe up to $1,630 of income from work. So regardless of how much you're going over the limit, Social Security, now listen to this is hard to believe, okay, is going to work this in your favor. That means that they're going to look at how much is this person earning this year? 30,000. All right, so if we do the 1-for-2 withholding, how many checks can we pay this person? Okay, well, maybe we can pay them, all right, 4 checks during the year. Okay, depending on how much your Social Security is, of course. But if we break it down by the month, instead of paying only 4 checks, we might be able to pay them 7 checks. Because there's going to be 7 months their income is going to be under $1,630. One occupation I can think of is as a consultant. I'm taking the summer off. I'm not doing any work. Clearly, I won't have $1,630 a month in income. But maybe in the fall, I'll start up slowly. I'm going to keep golfing, okay? I want to be on the golf course. I don't want to be consulting. So whichever earnings test is to your advantage is what Social Security is going to be looking at. Very, very important at the very beginning of the year. If you plan on going over the limit, call Social Security and report it. Say, I estimate, okay, this is what's going to happen. What happens if Social Security holds back 6 months of checks? And you estimated 30,000, but yet you only earned 20. At the end of the year, file your taxes. Social Security will get that new amount posted to your record, and your record will know, oh, wait a minute. The computer will look at this and say, yeah, this estimate of 30, okay, we held back 6 checks. We shouldn't have done that. They actually only earned 20. So let's reimburse them some of those checks. So you are reimbursed those checks if they held back too much. The opposite is true. If you estimated 30 and they should have held back, and you earned 35,000, maybe they should have held back 1 or 2 extra checks. So you get a bill. Okay, you've been overpaid. So, okay, let's move on. This holds true for anyone under full retirement age. What happens the year you reach full retirement? Now, the income level goes from 19,560 this year to 51,960. That basically means if you're turning, let's say your full retirement age is 66, and you're reaching 66 in July, you've reached your full retirement age. Your annual income is 60,000. So about halfway through the year, you've earned 30,000. And that's the month before you reach full retirement age. What's that mean? That means that you've earned less than $51,960 before your full retirement age, which also means you can collect all 12 months of your checks because you're not over the earnings test. Comprende? Okay, good, good. It's not always an easy concept to remember. If you don't remember it, we're there for you. Get in touch with us, okay? Send us an email, give us a call. We'll help you get through this bewilderment thing, okay? The 4330, again, is a monthly earnings test thing that if for any reason during that period before you reach full retirement age, you had earned $500,000, okay? But yet you had 1 or 2 months that you took off and you had no income. If you had income less than 4330, we can still pay you. Or I keep referring to we. I don't work for Social Security anymore. Social Security will still pay you those 2 months. I catch myself all the time with that. Sorry. Okay. All right. So, moving on. Retirees, who can collect benefits? All right. Who can collect benefits? Retirees who have their 40 credits, they're at least 62, and which basically comes out to the 10 years of work, okay? Depending on the earnings test that we just went over, okay? If you're not sure whether you should or you shouldn't, again, one of the biggest questions, as Jerry was talking about, that we receive is, when should I do this? Okay? I love those emails, don't you? I mean, every so often we get an email. I'm turning 62, what should I do? That's it. Okay, that's the email we get. I don't know. What do you want to do? Okay? It's very personal. It's a very personalized type of benefit. Everybody is different. I used to refer to Uncle Joe at the 4th of July family picnic. Uncle Joe was the Social Security guru. He would be telling all the relatives and all the friends what to do with their Social Security. So we would get calls because Uncle Joe was giving out information. And a lot of it was wrong, okay? Because this relative and that relative, and even though you may be related by blood, you have no relationship to what you want to do with your retirement benefits or where you want to go with this in your retirement years. It's different for everyone, okay? So whatever your decision is to make, whatever investments you may have, how old you want to be, how soon you want to do this, whatever your longevity in your bloodline, a lot of factors to look at and determine. Spouses of living retirees, you can retire as early as 62, living spouses, okay, we're talking about. Current ex-spouses, that's a biggie, okay? Many of my seminars while working, where I could have done a whole seminar on just divorced spouses. I'll never forget 4 women in a front row once, all divorcees. They got to asking questions. Oh my God. I thought it would never end. One of them had been married 4 times. What do I do? Punt. I don't know. It's just maybe stop getting married. I'm sorry, you know, but I think that the most I ever had from someone applying for benefits for it was divorced spouses. She had been married 6 times. Yes, that means I saw Zsa Zsa Gabor. Yes, okay. Survivors of deceased retirees. Now, widows, widowers, works both ways, can begin retirement benefits as early as 60 under their deceased spouse's record. How about that? You don't have to wait till 62. You can start as early as 60, but you are still subject to the earnings test. Okay, it is a retirement benefit. So again, where that $19,560 came in the picture, still applies. All right? Okay. 50 if disabled. So if you are a widow, or widower. You've lost your spouse. You have worked a little bit in your life under your own, and you have a very small Social Security benefit, but yet your spouse had a much larger Social Security benefit than you. You can apply for disability benefits as a disabled widow or widower. And if that's a higher benefit for you, you receive that as early as 50 through 60. That comes out to about 71.5% of your deceased spouse's benefit. Current and ex-spouses, dependent children under age 18, dependent parents. In my 34 years history, I never took a dependent parent claim. That is so rare, okay? There's so much to actually prove there. And if that piques your interest, I would recommend that you look it up, okay? Dependent children, that's a big one. I think we probably all know someone in our lives, in our family, friends, or in our community that were affected by a deceased parent who left behind a spouse and young children. It's very sad, but Social Security insurance benefits can cover paying out some benefits on a monthly basis to a widow or widower that's still young, still has young minor children in their care, okay? All right. Disabled workers with enough quarter credits, and that varies with the age when disabled. And that can be vast at best, okay? Depending on the age of an individual and then when they become disabled. It depends on how much you have to have paid in to Social Security in order to qualify. And here again, if you're under age 30, you need so many credits. If you're over age 30, you need, again, so many credits and have paid in what they call 5 out of the last 10 years of work, okay, which can be credits here and there all around over a 10-year period. As long as you have 5 years of credits, you can qualify for disability benefits. Disabled adult child. If you have a child that is disabled or becomes disabled before age 22, it doesn't matter how old that child is today. We have this. We have these questions posed to us every so often. I'm going to be full retirement age this year. I have a disabled adult child who's 45 years old. They've never paid into Social Security. Can that disabled adult child qualify? Absolutely. Mom and dad can actually get an additional check paid to them each and every month as long as there is proof, medical proof, that child became disabled before their age 22. Okay? All right. How is your benefit calculated? I'm not going to spend a lot of time on this. But here again, what I just want to basically tell you, all right, you can read this. I'm not going to stand here and read all of this for you. Take your highest 35 years of indexed earnings, basically your highest 35 years of adjusted income, adjusted for inflation, okay, income. And that is what is used to compute your benefit with, your retirement benefits, okay? If you retire, no, let me pose this way. If you decide to start receiving Social Security, let's say at full retirement age, or even if you wait till you're 70 and you've continued working, you have your own business, you have your own company, you're making millions, it's like, you know, this is my baby, I don't want to let it go, all right? You can continue working, still collect your Social Security checks, and guess what probably continues happening? You continue getting increases in your benefits each and every year that is over. You file your taxes, and lo and behold, you have another high year of Social Security income. Well, believe it or not, what happens here is that replaces one of your 35 years. Add that one, and guess what? You get an increase in your benefits. All right, we're going to move things along here, but COLAs, again, COLA, I don't want to beat this into the ground, okay? Here again, You can take a look at this when you get a chance. Averages, you change over time. It all depends, again, on, the consumer price index, what's happened in the past 12 months. And cost of living adjustments, historically, Social Security, this is how things have worked, is that there's been some really good years of cost of living increases. There's been some so-so, all the way down to no. 2010, 11, 16, there were no cost of living increases for people on Social Security. So anyway, okay. We are going to move on to our next speaker, which is going to be Mr. Rusty. Thank you, folks. I'll be back in a little while. You don't need that.
Here, there we go. Am I on? Oh, good. Whoa. So just to go back to that COLA thing, if you look at that bar chart with bars up and down and some with zero, if you look back across that history, the average COLA increase is about 2.2%. So even though we got 5.9 this year, that's unusual. There hasn't been a 5.9 increase in decades, many decades. So full retirement age, Ken referred to full retirement age a number of times. So let me tell you what it is, because what it's not 65. It was 65 since Social Security was signed into law in 1935, but it changed with some laws that were passed in 1983. Starting in the year 2000, the full retirement age started going up for those who were born after 1938, after 1937. It started going up a couple of months from age 65. When it reached 66, it stopped, and anyone born up to 1954 had a full retirement age of 66. After that, their full retirement age went up 2 months for every year they were born, to the point that it gets to age 67. Anyone retiring today has a full retirement age of between 66 and 67. Now, when I say retiring, I mean when you claim Social Security. The full retirement age is critically important to your benefit amount. It's one of two things which really determine what your benefit is going to be. The first thing is on one of the previous charts was that 35-year average history that Ken spoke about. The next thing that's going to affect your benefit is when you claim relative to your full retirement age. Now, how is full retirement age figured? You got the years right there. If you were born between 43 and 54, it's 66. If you were born after 1960 or later, it's 67. And if you were born in between, it's whatever your year of birth translates to for that full retirement age. The thing I want to impress upon you is when you claim relative to your full retirement age determines how much your benefit is going to be. I think it was mentioned before, if you claim before your full retirement age, it's going to be cut. If your full retirement age is 67, the cut's going to be 30%. If you wait, on the other hand, until you are 70, as Ken mentioned, you're going to get 124% if your full retirement age is 67. And if your full retirement age is 66, you're going to get 132%. So that full retirement age, keep that in mind. That's very, very important. Raising the full retirement age, there's no legislation right now in front of Congress that proposes to do that. But that's not to say that there won't be, because Social Security, the full retirement age of 67 was great back a number of years ago. The reality is people are living much longer today than they did when those full retirement ages were established. So I think we'll get into a little bit later a section about Social Security's finances. And there are some financial issues that Social Security has. So legislation will need to be passed sometime in the hopefully not too distant future that may include an increase in the Social Security, in the full retirement age, okay? That's not going to affect anyone who's already collecting benefits, because that would affect future retirees, people who would claim later. But it's not, you don't have to worry about that if they raise the full retirement age. So we go back to this, what's a good age to claim? I like the one Ken mentioned before about we get these emails that say, I'm turning 62, when should I claim? Well, some of them say, I'm turning 62, how can I maximize my benefits? Well, at age 62, you're not maximizing your benefit. You claim at age 62, you're taking a cut. The only way really to maximize your benefits is to wait until age 70 to claim. But don't think of that as a general rule, because it's not. There are so many other things to consider, not the least of which is your health. If you don't think you're going to live to a ripe old age, then you probably don't want to wait until age 70 to claim benefits. On the other hand, if your family history says, and you live a clean life, that you don't drink and you don't drive without your seatbelt and all of those things that pretend to get you to a higher age, if you think you're going to die younger, then you probably ought to claim at your full retirement age. So when do people claim? By far the majority of people claim at age 62. And by far the majority of people do that because they've worked their entire lifetime, contributed to Social Security their entire lifetime, and they say, I'm 62 and I deserve it, so I'm taking it. And they don't really understand the ramifications of what they've just done. People do it and they are still working. Many people then get surprised, as we talked about before, that, whoa, wait a minute, you mean to tell me that my earnings affect my Social Security benefit? Absolutely, they sure do, as Ken was pointing out. So it's very important that the entire picture be looked at. What are your work plans? It's also important to look at, are you married? Do you want to leave a higher benefit, a higher survivor benefit for your spouse? We talk to people that are, 75 years old with a spouse of 55 years old. So chances are the 75-year-old is going to die first, right? So they should think about maximizing their benefits. Now, at 75, you can't do much to maximize your benefit. But the point being that if you're older and you think you're going to outlive your spouse, then it's a good thought to think about maximizing your benefit by waiting longer to claim. I have noticed that there's been a shift. These numbers I pulled off of the Social Security website that says about 42 to 48%, depends on whether it's a man or a woman, claim at age 62. And you can see the numbers, the next one, of course, is full retirement age, but you can see there's not a lot of people that wait until 70. I have actually noticed a shift over the last few years that more and more people are waiting longer to claim. I personally think that's because more and more people are staying healthy longer. More and more people are working longer too. It's very common for us to speak to people in their 70s and 80s and even their 90s who are still working, like me. But the thing I want to leave you is, if you're not yet collecting, don't claim Social Security because you believe some of the stuff that goes around in the news media that Social Security is going bankrupt. Social Security is not going bankrupt. Stop and think about this. You got 175 million people right now working and contributing to Social Security. The only way that you could not get Social Security benefits is if all 175 million of those workers stopped working. And I just don't think that's going to happen. I mean, you may disagree, but I don't think that's going to happen. Okay, so Social Security is always going to be there. But what might happen, unless Congress actually stops kicking the can down the road and pass a little reform, you could have a benefit cut in 2033, 2034, it kind of varies. But it'll always be there. You might get a benefit cut. Now the projections are 21 to 23%. If Congress doesn't do anything, do you think that Congress is not going to do anything and suffer the wrath of 65 million seniors who vote? That's not going to happen. So they will fix it. They already know how to fix it, but they need to do something they seem to be very unable to do, and that's cross the aisle and find a solution that's satisfactory to both parties. This, I just want to emphasize for you the difference in benefit from claiming at 62 versus claiming at 70 or full retirement age. This is, the red line is if you have a full retirement age of 67. The blue column is if your full retirement age is 66. And you can see how that ramps up. So you start down here, it's 25 to 30% less depending upon your full retirement age, but you get up here and it's 24% more or 32% more depending upon your full retirement age. So it's very important, and you really need to look at your whole picture. That's why this we always use the "it depends," but that's why it's kind of humors us when we get an email or a phone call that says, well, I'm turning 62 and I think I'm going to collect Social Security, so how do I maximize my benefits? You know, that's not the way, claiming at 62. Break-even analysis, this is one piece of the puzzle, only one piece of the puzzle. This will tell you if you decide to, if you want to know when you would break even if you claim at 60, at your full retirement age instead of at age 62, that's what that chart tells you. Or if you want to know when will you break even if you claim at 70 instead of your full retirement age, that chart will tell you. I can tell you, I've done dozens of these analyses, and if you wait until your full retirement age to claim, you're going to break even within a half of a year of age 78. Now that changes if you say, well, instead of my full retirement age is 67, I'm going to retire at 60, or I'm going to claim at 66. Those numbers go out the window. But if you look at someone who's looking at claiming at 62 versus their full retirement age, it's going to be within a half a year of 78. And if you wait, if you want to know what your break-even age is going to be if you claim at age 70 instead of your full retirement age, then the answer to that is 83. So here's where life expectancy comes into the picture. Because now, if you look at study it with Social Security, they will tell you that on average, a healthy woman in her early to mid 60s, on average, will live to 87. And a healthy man at that age in their 60s will, on average, live to about 84. So if you have a break-even age of 83 and you're going to live to 87, it's kind of a no-brainer that as long as you don't need the money earlier, you're going to make more money over your lifetime by waiting to claim. Now, I do want to mention, Jerry mentioned the foundation website before, specifically the Social Security report website. There's an excellent life expectancy calculator on that website. And it's a calculator that takes your lifestyle and your family history into account and asks you a whole bunch of questions about your lifestyle. And from that, calculates what they estimate your full retirement, your life expectancy to be. Okay? And I'd recommend if you're contemplating, if you simply just want to know how long you're going to live, according to that, And I've done it, and I was pleasantly surprised, believe it or not. And here's an interesting thing too. I did it several different ways because you can change the questions and everything. And I found out that my life expectancy improved if I said I had 1 to 2 drinks a day. So I have used this to justify to my wife. So anyway, I do recommend taking a look at that life expectancy calculator. It'll be on the Social Security report website. It's kind of the bottom of the page. You'll see the life expectancy calculator. That's what it's called. Okay, so with this chart, I'm not sure you can see these colors very well, but this chart demonstrates that Social Security as it exists today is actually a somewhat progressive benefit program. It's generally designed to provide more replacement income to lower income workers. That is to say, a person when they retire, how much Social Security benefit are they going to get? A lower income worker is going to get about 40% of the earnings that they made before. These deal with different categories of earnings, okay? So this is on the low side. This is a higher side. This is those who earn even more, and this is those who earn maximum. So the percentage over here of replacement income, if you can see these colors, the replacement percentage is much lower over here compared to over here. 40% over here, it's about 20% over here. So replacement income is how Social Security works. I don't know if my next chart is the one I'm thinking of. Oh, the thing, here's an important point too. Because we hear from so many people who have so many, let's say, wrong ideas about Social Security. Shouldn't even exist. It's a big Ponzi scheme, and you know, just cut it out and, you know, let people live what they may. That little shaded area on top that says 50% of couples and 70% of singles rely on Social Security for half of their retirement income. And 21% of couples and 45% of singles rely on Social Security for 90% of their income. And I have to tell you that there are people whose only income is Social Security. Social Security lifts about 15 million seniors out of poverty every year. So when you hear people say, you know, it's a big Ponzi scheme and we shouldn't even have it, it should just go away, just think about that. Do we really want to put 15 million seniors into poverty? I think the answer to that is obvious. And dispelling myths. Okay, so have you ever heard anybody say, I will never get back from Social Security what I paid into it? We've all heard that. The answer to that is yes, you will. Well, let me qualify that. Yes, you will if you collect only for a few years. This chart demonstrates that people in those brackets that were in the previous chart, this is low income. This is somebody who made 50%, constantly made 50% of the national average wage index over that 35-year period that Ken was mentioning. And this is someone who made 100% of the national average wage index. This is someone who made 150% of it. And this is someone who was fortunate enough to have earnings that met or exceeded the annual payroll tax cap, so they contributed the most that they could possibly contribute to Social Security. And here's the surprising thing. For those in the low income side, they will actually get back in 34 months as much money as they contributed to Social Security. And even on the higher side, with just a little over 5 years, you'll get back everything that you contributed to Social Security. And the longer we do this, the longer people are living. So, as I mentioned before, we talked to octogenarians and nonagenarians, and they're still collecting Social Security. Ken mentioned the fellow that used to go out and talk to people who are 100 years old and worried about it. Social Security doesn't stop. You get it forever. People will actually collect hundreds of thousands of dollars more if they live longer. Of course, you got to live longer, you know. And that estimate assumed a 2.2% cost of living increase. So, thank you.
Thank you, Russ. So I've already covered some of these things. I got ahead of myself earlier. Kind of get carried away sometimes, don't you think? But anyhow, so continuing to work, obviously, like I mentioned earlier, you continue to work, you're collecting Social Security, guess what? You can still get some increases in your benefits because higher income, current income, can replace one of those low 35 years of income that was previously used to compute your benefit. So you get an increase because of that. Continuing to work after starting your benefits early before your full retirement age does affect your benefits as well. I covered that pretty much in detail earlier. And the monthly earnings test, I think I also covered that if you were expecting to earn X amount, and there are months that you don't earn a certain amount that you can still get paid for some of those months. If you do exceed the annual earnings test, then Social Security does withhold that 1 for 2 over the limit. After you reach full retirement age, there's no longer an earnings limit. The month you reach full retirement age, you can earn anything you want. If you want to apply for your Social Security, it'll get paid to you, all right? Anything withheld from your benefits may eventually be returned. Let me explain that, because some people are under the assumption that if somebody retired at 62 and started collecting, I should say, at 62, and then they reached their full retirement age at age 66, 4 years later, and half of that time they were still working and earning over the limit, so Social Security withheld, let's say, 24 months of benefits. You know, a few 1 year, a few another year, and so forth. Well, once you reach full retirement age, Social Security doesn't pay you all those checks back, okay? That's what Uncle Joe was telling the relatives at that 4th of July picnic, all right? You're going to get all those checks back. So people at that 4th of July picnic call Social Security, and they're all upset because Uncle Joe said so. But Social Security tells you otherwise. What does happen once you reach full retirement age? Now, and this doesn't happen until the year after, the calendar year after you've reached full retirement age, is that you get an adjustment to your Social Security. It's called an adjustment to the reduction factor, an ARF. We used to always poke fun at some of these acronyms. So the adjustment to the reduction factor is basically for those 24 months you didn't get paid Social Security. Social Security gives you back credit for that. The credit is as if, think about it, you applied at 62. Your benefit was reduced to age 62. Those 24 months are added back. So as if you had, instead of retired at 62, you retired at 64. Get it so far? All right, those credits. So your benefit amount is recalculated back to what you would have received basically at age 64 instead of 62. So that reduction factor is readjusted to a higher benefit amount. And starting with the month that you turn full retirement age is when that adjustment takes effect. So if your full retirement age during a current year, you still have some checks that might have been withheld by Social Security, Social Security has to wait till the following calendar year when your earnings have been updated by IRS to your earnings record with Social Security. And then that ARF is applied, okay? All right. I skipped one. Hold on. So, special rules for the year you reach full retirement age. Again, I kind of covered this real quick, so I'm not going to spend a lot of time on this. Between January and the month you reach full retirement age, you can earn up to this year $51,960 without any reduction. Hard to believe you can earn $51,000 plus and still receive your Social Security checks during those months that you're earning that $51,960. If you exceed that amount, then Social Security can withhold $1 for every 3 you earn in excess. Instead of the 1 for 2, it's a 1 for 3 in this case. If this is the first year of taking your benefits and you continue to work, then that $43.30 per month earnings rule can apply. Does it apply to everyone? No, it doesn't. It depends on your particular situation. Everyone is different. And again, this earnings limit disappears once the month you reach full retirement age. Now, I also, we get questions too. Say, okay, so my birthday is July 15th. So that reduction starts with July 15th. No, it's effective July 1st, okay? The full retirement age is that month you reach full retirement age. Now, there can be a special exception if you're born on the 1st of the month. There's a possibility, and it probably will apply, that Social Security will deem your full retirement age to be, instead of July, to be June. Okay? So, are Social Security benefits taxable? Oh boy. I have to be the bearer of bad news, but yes, it can be. All right? So, now, Social Security refers to the modified adjusted gross income, the MAGI. Okay? And I'm not talking about Christmas and when the Magi visits and all that, okay, in the Bible. I'm talking about the taxation Magi. So, if you are filing single and your income is between $25,000 and $34,000, which includes possibly up to 50% of your Social Security, your benefits can become taxable. Again, this is going to vary for every single person. Married filing jointly, $32,000 to $44,000. Pretty much a guarantee, again, that your Social Security benefits will be taxable up to a certain percentage. Now, one thing, folks, is that we do get a lot of these questions, okay, will my benefits, and we deal with Social Security questions and Medicare questions. Taxation really is on the shoulders of IRS and all their rules and regulations, so we can give you some general information. That's what I do, kind of give you some general information. And even if you go to Social Security's website, that's what they also provide the public. Very generalized answers to it. You basically have to deal with IRS. I always recommend, look, folks, you have an accountant, you have someone that deals with taxation all the time. They're probably the people to really go to, especially if you have complex filing situations, which now you're throwing in Social Security benefits into the mix. You should probably consult, of course. If the first level exceeded, then up to 50% of your Social Security benefits do become taxable, and up to 85% of benefits can become taxable income. And it says benefits not taxable, the first Magi, okay, threshold is not reached. So basically, the numbers you see up there, if you're not reaching those numbers, then it's pretty much a guarantee that your Social Security benefits will not be taxable income. Absolutely. I was afraid someone would ask me the modified adjusted gross income would be. Sure. I'm going to get my expert because he's coming up anyhow. I'm going to get the expert up here to answer that. I appreciate it, Rusty.
Okay, you call it Magi.
Magi.
I reserve that for Christmas, so I'll call it Maggie. So, thank you. So your modified adjusted gross income really consists of several things. The biggest thing is your adjusted gross income from your income tax return. It's the AGI, and that includes everything that's taxable, right? You know how that works. If you have earnings from working, it includes that. If you have a retirement pension, it includes that. If you sell some property, it includes that. It includes everything that's taxable. So how they get to Maggie is they say, well, you know what? It's not only your taxable income that is going to determine whether your Social Security benefits are taxable. It's also your non-taxable income. So if you have non-taxable interest, anything that's non-taxable is added back into your adjusted gross income, and 50% of the Social Security benefits you earned for that tax year is also included in your Maggie. And when all of that is all added up, if those numbers are bigger than the ones that Ken showed you there, 25,000 or 34,000 if you file singly, or 32,000 and 44,000 if you file as married filing jointly, okay? Then your benefits are going to be taxable at the rates that Ken mentioned. One point is that, no, never mind. That's a different thing. Sorry about that. The blue things on the bottom, I just want to make sure that you're aware of this. If you claim Social Security, they don't automatically withhold income tax from it. If you want to have income tax withheld, you can do so. You simply need to fill out and submit IRS form W4V, which will allow you to select certain percentages that you want withheld from your Social Security benefits. I learned that lesson pretty quickly because when I started collecting Social Security, and at the end of the tax year, when I filed my income tax and realized that no tax had been withheld from my Social Security, it was a pretty big hit. So.
Thank you.
Huh? This is forward, and this is back.
Hi. My name is Arlene Sharp. I started with AMAC in 2013 as a member service representative. And then in July of 2019, I transferred over to the AMAC Foundation to train to be a Social Security advisor. And that just happened to coincide with my 65th birthday, so I think it was perfect timing. We're going to talk about, if I could change it. Social Security, disability insurance. This is something that's available for people who become disabled before they reach their full retirement age. It has to be a condition that prevents you from engaging in something they call substantial gainful activity, which for Social Security purposes means you are not able to make any more than $1,350 a month. And the condition has to be expected to last 12 years as a result of 12 months as a result of death. And you have to have sufficient Social Security work credits to apply. Apply as soon as you become disabled because the process can take a while. It says 3 to 5 months here, but a lot of times it can be longer. And there are some compassionate allowances for really severe diseases that they will kind of push to the front of the line to get processed more quickly. And there's a 5-month waiting period, even after it's approved. So it does take some time. Something I wanted to mention is if you happen to be 62, say, and you're disabled, but you really need to have some money coming in, you're financially strapped, you can apply for Social Security disability insurance, and then you can apply for early retirement benefits. And what that'll do is generate some income coming in while you're waiting for a determination. If you're approved for disability, then your payment will increase. If you're not approved, then you'd stay at the reduced benefit that you took at 62, which is the negative side of that. But if you really need to have something coming in, that's an option. Also, if you reach the age of 62 or more and you're on disability, and your disability happens to be less than what a spouse benefit would be, and your spouse is collecting their Social Security, you do have the option to switch from your disability benefits to your spouse benefits. This could be a seminar on itself. Spouse benefits. Technically, the definition of a spouse benefit is if both spouses, say both spouses have reached their full retirement age, and the lower earning spouse has been 100% of the lower earning spouse's benefit is less than 50% of the higher earning spouse's benefit, the lower earning spouse may be eligible for what we call a spousal boost to bring them up to 50% of their higher earning spouse's benefit. So that being said, it applies to spouses and ex-spouses if they were married for more than 10 years and haven't remarried. And if you take it earlier, just like any other Social Security benefit, it's going to be reduced. So it's not going to be 50%. It'll be less than that depending on the month that you decide to take the benefits. And if the benefit amounts are too close, then there's no eligibility for a spousal boost. And moving on to survivors. Once again, the surviving spouse at their full retirement age will get 100% of the worker's benefit if they've been married for 9 months or more. Surviving ex-spouses, same rule of 10 years or more. And reduced benefits, for the surviving spouse can be, you can get those younger, like Ken explained earlier. Also, dependent minor children and parents may apply to get benefits, depending on the circumstances. There is a family max, so if there's more than one person applying for the benefits, that's going to be split between the people. And the family max can be anywhere from 150 to 180% of the primary worker's benefit, and that's something that Social Security figures out. Let's see. Oh, the other thing is if you wait, of course, if you're under full retirement age, again, the survivor benefit's going to be reduced. The survivor benefit's not subject to deemed filing. So if you were, say, 62 and taking your benefits and your spouse passed away, if you took it then, it would be reduced. But if you wait if you can wait till your full retirement age, then at that point, you would get 100% of the survivor benefits that your ex-spouse was getting, your spouse or ex-spouse was getting when they passed away. And this is just a chart to kind of show you how that works. Like if the spouse's primary insurance amount or full retirement age amount was $2,500, 50% of that would be $1,250. That would be the maximum spouse benefit. And if the lower earning spouse's benefit was $700, then Social Security would take the spousal benefit, deduct that person's own benefit, and increase them by $550 to bring them up to 50% of the spousal benefit. And it just kind of shows the different percentages for what year, how old you were when you decided to do that. Restricted application for spousal benefits only. This is a strategy that is rapidly disappearing. I think the best way to explain it is to kind of give you an example. Say if both you and your spouse were born in 1953, before, January 2nd, 1954. So if you were both born in 1953, your spouse is taking their benefit, but you haven't started yours yet. You can actually file a restricted application for spousal benefits only, and you can get 50% of your spouse's benefit while you wait and let your own benefit continue to grow to the age of 70. It's a wonderful, lucrative deal, and it was considered a loophole, so it was eliminated back in 1983 when some changes were made, but the cutoff point is January 2nd, 1954. If you were born before then, you can still take advantage of this strategy. Oh, yeah. And this is a good one. Divorced spouses can file on each other for a restricted application. Of course, if they were married to each other for more than 10 years and they were both born before, the cutoff date, and ex-spouses are eligible to do that too, just like any other spouse benefit. And I guess that's about it for that. And that, let's see, maximum taxable earnings. I think Ken did a great job of explaining this earlier. This one's just about, if you make over $147,000, you don't pay Social Security payroll tax on any more than that, but you still pay the Medicare. So if you make $200,000, then you pay Social Security payroll tax on $147,000, and the rest of that is not taxable for Social Security purposes. And that's about it for me. Thank you.
If it's me, then it must be windfall elimination provision time. So Jerry mentioned, I think, earlier that we're not going to go into a lot of detail on this because this audience probably won't be affected by it, but it's good to be aware of it. If anyone here is a school teacher or a public servant who has a pension that they did not contribute to Social Security from, then talk to us afterwards and we'll go into more detail. What the windfall elimination provision does, it corrects what Social Security thought was a disparity between the benefits paid to someone who paid into Social Security for their whole life and someone who didn't. Okay, so that was considered someone who had a pension, earned a pension without contributing to Social Security. From Social Security's perspective, that was a windfall, and thus the windfall elimination provision. What that does is if you are eligible for both Social Security and that non-covered pension, then the windfall elimination provision is going to reduce your Social Security benefit according to the number of years that you earned or that you contributed to Social Security. So if you actually had a non-covered pension from, let's say, a school district or something like that, and you also worked for 20 or 30 years contributing to Social Security, then it's going to be a sliding scale. The reduction to your Social Security benefit is going to be a sliding scale. If you contributed to Social Security from substantial earnings for 30 years or more, then it doesn't apply. If you contributed to Social Security from substantial earnings for 20 years or less, you're going to get the maximum reduction. And if you're between 21 and 30 years, the number is going to be less. The reduction number is going to be less for each additional year over 20. Okay, so let me just look at this chart. I think I just covered that. There is a way to avoid it, but I've not yet met anyone who takes it, because what it means is you have to forfeit your non-covered pension, and you have to do that before you start collecting it. And there's not many people that are willing to forfeit their pension. There are certain situations where it does make sense to do that, but normally it doesn't. Or you can withdraw all of your own contributions and any interest that you made on them from your pension amount. So, now if you are affected by the windfall elimination provision, then you're probably also affected by the government pension offset. The windfall elimination provision affects your Social Security retirement benefit, the benefit you earned from working your whole life. That's your Social Security retirement benefit. If you are also entitled to a spousal benefit or a survivor benefit, then you're going to be affected by the GPO, the government pension offset. The math is a lot simpler for the GPO, because with the GPO, they simply say, what is the amount of your non-covered pension, and they take 2/3 of that amount and reduce your Social Security survivor or spousal benefit by that amount. They reduce it by 2/3 of the amount of your non-covered pension. What that usually does is eliminate the spousal benefit, and what it frequently does is eliminate the survivor benefit. So if you were a government employee who earned a pension without contributing to Social Security, these two provisions are going to apply to you. And that affects teachers in Florida, for example. In fact, we were given a seminar yesterday where we had to unfortunately tell this lady that she had 31 years as a teacher, and obviously had a sizable pension, but she also was entitled to a Social Security benefit from her early years, and she would have gotten a survivor benefit from her husband. It was almost heartbreaking to have to tell her, you're not going to get your full Social Security benefit, and you're not going to get a survivor benefit. So it's really an impact. We hear from people all of the time, from police, firemen, teachers, school teachers especially. School teachers are affected in 12 states. The WEP provision can apply in about 26 states plus the District of Columbia. People who work for those state agencies, and it varies by state. California and Texas, for example, almost all who work for the state are affected by these provisions. Some of the other states, the rest of them, the other 24 states, to varying degrees. It depends on the agency. But anyway, these are very, very hurtful things. As you probably can imagine, they are reviled by people who are affected by them. And we're sympathetic to that, but these are laws that were, you know, they're laws on the books. And as much as we can sympathize, in some cases empathize, with being affected by these, such as this gentleman right here, they are nevertheless law, and they therefore apply to people who with a non-covered pension. So that should be it for me. Here is our Medicare expert, Eileen. You want to use that or this?
Oh, let's talk Medicare. Medicare, basically broken down into 4 sections, which is Part A, Part B, Part D, and Part C. The reason why we flipped that, I'll discuss that in a second. Part A is inpatient, Part B is outpatient. That is your doctor visits, medical tests, lab work, all that delightful stuff. And then you have your Part D, which is your drugs. You can always remember your Part D as drugs because it's D. Then you have your Part C, which is a Medicare Advantage plan. Now, a Medicare Advantage plan, think of it as a combo plan because it's your A, B, and 89% of the Medicare Advantage plans have a Part D in it. So think of it as a combo. That's a good way to think of it. The others then go, oh, wait a minute, what is it? Just think of it as a combo. So, and of course, you know, Part A is free for those eligible for Social Security. Part B has a standard premium, which is $170.10. We'll go into this a little further in another slide. Your Part D premiums vary by provider and plan selected, and Part C, of course, may or may not have an additional cost. All right, so Medicare doesn't cover everything, as a lot of people will find out if you haven't found out already. It's prescription drugs, some of the things is eyeglasses, exams, hearing aids, exams and fittings for those hearing aids, dental care and dentures, long-term custodial care. That's, the custodial is the key word, and acupuncture and routine foot care. Now, Medicare pays 80%, and you have a 20% deductible or copay. Actually, I should say copay first, deductible first, then copay if you haven't hit your deductible first. So Part A deductible is $1,556. Part B is $233. Now, a lot of people, when they go for Medicare, they do the traditional, which is Part A and Part B, or original. You'll hear it called either original or traditional. They'll take a Medigap plan. Now, a Medigap plan is exactly what it is. It's a supplement to your Medicare. It's sold by private companies that have to follow federal and state laws. And the plans range from what they call Plan A through Plan N. Now, they also have to, it's a standardized plan, so they only can sell you a standardized plan. They can't tweak it or anything. Now, Medicare Advantage plans now, they usually cover, as I said, the combo plan, plus they give you a little bit more. Most of them cover dental. Some of them will cover different other aspects, eyeglasses, hearing aids, and things like that. Just for an FYI, there is 3,834 Medicare Advantage plans nationally. You're not going to have them all in the state of Florida or whatever state, but that's basically what it is. And like I said before, 89% of them have a Part D. So now, when you, there's a bone of contention about this first sentence, which is you must have Part A to collect Social Security at age 65. A lot of people do not like that. They feel it's separate, but for whatever reason, many, when they decided that was, they're going to lump it together. Now, remind you, you do not need to take Medicare at 65 or Social Security at 65 because you're taking Medicare, nor do you have to take Medicare at 65, and we'll go into that a little later. But Part B isn't mandatory, and Part D is not mandatory because you're paying a premium. However, if you do not take it in either your initial enrollment period or your special enrollment period, for either one of those, you'll end up paying a lifetime penalty. And we'll discuss that in a second. So you can defer, like I said, enrolling into Medicare if you're 65, if you have credible, current health care coverage from an employer. Now, what is credible health care coverage? Group health plan, more than 20 employees enrolled in that group health plan. So I have to break this bad news to a lot of veterans. Your veteran health care is not considered credible. Your drug coverage is because it is as good as Medicare. However, for veterans, it is not your replacement for Part B. It's not credible for that because there are different levels of veterans care or benefits. There is also not all veterans get that benefit. And also the worst part, which I think is a shame, it's because it is a discretionary thing. That means it is up to Congress to give money to the VA to run their health care. So that's why. That's one of the top reasons why it's not. I know, I agree, it's a shame. Retiree health care plans are not credible because basically you're not guaranteed. And that's basically what it is. You're not guaranteed. Your company, and we've seen this happen before, even municipalities have done this to their retirees. We're not covering your health care anymore. And so, unfortunately, I've had a few, I think Chicago Fire Department did that. And several of them never picked up Part B because they had retiree health care. And they had to break the news to them that they had a penalty. So. Then you have the faith-based and other health sharings aren't credible either because it's also not guaranteed. Okay? It's the whole thing about guaranteed is very important. And then let's talk about, I talk very fast, sorry. Late enrollment penalty for Part B and D. As I said before, if you do not enroll in your initial enrollment period, which is 3 months before your 65th birthday, your month of your 65th birthday and 3 months after your 65th birthday, or during a special enrollment period, which is 8 months, and that is when if you're covered under a employer health care plan and you retire, you're no longer part of that group health plan, you have 8 months to pick up Part B without a penalty. You have 63 days to pick up Part D without incurring a penalty if you do not have credible coverage. And we're talking 10% for Part B is 10% for every full 12 months. Part D is 1% for every month, full month. So that's the one a lot of people get. They go, oh, Part B, but you also have Part D penalty, and that actually ends up being 12%. So think about it. If you go up a whole year, that's 12%. So now we're going to go into IRMA, which is the Medicare Income-Related Monthly Adjustment Amount. And I have a slide after this one. And then we have the Medicare Hold Harmless provision. The Medicare Hold Harmless provision is basically saying that your Social Security will not decrease because of Medicare premiums, increase in Medicare premiums. So there are people that even their COLA did not cover their Medicare premium increase. So they were held harmless to the point where it did not decrease their Social Security amount. Okay? Now, to qualify for hold arm list, you have to have your Medicare taken out of your Social Security, are eligible for that in November or December of the year, and have the Medicare premium taken out of your January payment. Otherwise, you're paying the full amount, the $170.10 as of this year. And also, if you're subject to IRMA, you don't have a hold arm list. Now, let's talk about this dreaded IRMA. And some people get hit, and a lot of people get hit usually when they sell property. Now, they sell property, they get hit with capital gains. That, as we talk about in the next slide, will not give you a chance to have have Social Security reconsider. But as you can see, it's based on your Maggie, whatever you want to call her. And as you can see, from the lower level, if your individual tax return is less than $91,000 and your joint tax return is $182,000 or less, or your filed married and separate tax return is $91,000 or less, you're going to pay the basic premium, which is $170.10 this year. Now, I want to point something out, because I actually had to point out the other day to somebody who says, I don't have to worry about that because we are married and filing separately. I said, well, let me show you something. So you can see from the married and separate, oh, this doesn't have a pointer, where it's $91,000 or less. However, it jumps to the $544.30 for anything over $91,000. Now, let's say your combined income was only the $114,000. Now, because you're claiming married and separate tax return, you're going to pay $540.30, and then when you could have been actually paying $340.20. So, people think they're going to get out of that by doing that, but they're not. So, now the reason you can ask for reconsideration, because it does, happen, life-changing event. It is marriage, is divorce annulment, it is the death of a spouse, it is a work stoppage or reduction, which is actually one of the most common things. And then we have the loss of income producing property, now in loss of pension income and employment settlement payment. Now, we get a call all the time and emails all the time. I get hit with IRMA because I sold a piece of property. And usually the question is, well, why did you sell it? Was it part of a disaster area? Was it part of did you have an arson? Did you do something like that? And then that's fine. That can be asked for reconsideration based on those things, like a rental property. However, if you just sold it because you didn't feel like doing it anymore, and you pay capital gains, you're going to end up paying the IRMA for a year. And it's only a year because it resets itself the following year when the taxes come over, and it's 2 years behind. Social Security looks at 2 years, 2 years previously. So this year, for 2022, they're looking at your 2020 income. So, like I said, you can always put in, and I always tell people it doesn't hurt to put in for the capital gains thing, the loss or whatever. It's a cost of a stamp, filling out paperwork, but don't get your hopes up. But I always tell them, do that. Now, there's also a thing too, when you fill it out, there is something in there that is not listed. If you ask for a reconsideration based on it will cost you financial hardship. They will ask you for all the financial information, but there is one that's usually not put on there, but they will look at look at it, if you can prove that it will cause financial hardship. Okay? And I think anyone has any questions? I know I talk very fast. And that's it for me. So the rest is jury. Sorry, I talk fast. You know me. There you go. Here's yours.
Basically, the seminar is done now, and I just wanted to take a couple of minutes at the end to make an impassioned plea for everybody to understand the Social Security solvency dilemma. I'm not going to spend a whole lot of time on this. This could be an entire afternoon discussion, and I'm going to keep it to about 5 minutes. But Russ talked early on about the fact that Social Security is not going bankrupt, and that's true. But that's not to say that Social Security does not have financial problems. And so what is the problem? The problem is that as of 2021, last year, for the first time in Social Security since 1982, as a matter of fact, Social Security reached the point of paying out more than it's taking in. And so to manage the continuation of benefits under that situation, the program is drawing on its cash reserves to make up the difference. The cash reserves had accumulated nearly $3 trillion through the years. And so there's a nice cushion, to make up the difference. But the problem is, over time, that entire $3 trillion is going to dissipate. And the current projection is that by 2033 or 2034 or 2032, depending on which report you read, the trust fund reserves will reach zero, and then benefits will be cut across the board, somewhere between 20 and 25%. Those numbers vary also, again, depending on which report you're reading. So there is a looming solvency crisis that we've been very active in researching ways to avoid that. Russ and I particularly work quite a bit with AMAC Action on looking at legislation proposals and things like that to try to avoid this problem. But it takes political will, and political will and political agreement is a difficult thing to come by these days. But we remain hopeful that it's starting to get attention, and that in the next, I don't know, it's just that it gets crowded out of the priority list, unfortunately, with everything else that's going on. But the longer the problem goes on and the reserves dissipate, the more severe the turnaround is going to be when the correction finally starts to happen. We don't know when that's going to be. But the question would be, how do we get to this point? Well, life expectancies are increasing. People are living longer, therefore drawing benefits much longer. Less workers are paying into Social Security. Back in the 1940s, there were, again, depending on which study you look at, maybe 45 people paying FICA tax to support Social Security for each retiree. Today, it's 2.8 to 1, and it's projected to drop to 2.0 to 1 by 2030. So there are less people paying into the system. Birth rates are significantly lower and dropping, and so that talks to replenishment of the workforce future. Interest rates are at historical lows. I mentioned the $3 trillion. Back when interest rates on Treasury bonds were 6 to 8%, that produced a lot of revenue. But interest rates in the past couple of years have been almost non-existent, in some cases really non-existent. So that's drawing down the revenue from the cash reserves. So what must be done? I won't even say can. I'll say what must be done. Changes have to happen in the program. There are legislative proposals all the time coming forth, and typically the approach is, well, we got to raise taxes or lower benefits, one or the other. We have a solution, and it's called the AMAC Social Security Guarantee. AMAC Inc. has that solution. It's not a foundation project, but we've consulted on it quite a bit. And if you take a look at that proposal, it's on the amac.us website, I think. Yeah, I have the URL in red. amac.us/Social Security. And if you take a look at that, that will outline what we think should be done. And in summary, what we're recommending is a increase in the full retirement age to age 70, and then some other formula adjustments, that would curtail benefits for the very, very high earners. So we think it's politically palatable, more so than just cutting benefits across the board, because that affects everybody. So I would encourage you to contact your congressional representatives and, first of all, express to them your concern about solvencies, Social Security solvency in the future, and then recommend that they take a look at the AMAC position. And also, there's an article out on the table. I would ask you to just pick up a copy. It puts a sort of a framework around the Social Security solvency dilemma and where we think it's going and what we think must be done. So that's it. I'll get off my soapbox now. But yes, sir.
I think there's another, something that's going to aggravate that problem in the worst is there's legislation where they want to increase the replacement income for lower wage earners.
I'm sorry, I didn't.
Lower wage earners, replacement income. I think there was some legislation proposed to increase that benefit.
Yeah, minimum benefit, yeah. Yeah, there are a lot of proposals that are in play right now. I don't think any of them will get enacted, but to increase benefits, particularly for lower earners, and that's a noble thing, but you have to have, the money has to come from someplace. So, yeah. But take a look at the AMAC Social Security Guarantee. We think it's a reasonable approach. And the key to that, the key to our approach is it creates no need for tax increases. So we think it's a very, very palatable way to approach the problem. So, but again, getting political attention is difficult at best. Most politicians are in office to run for office. And so, addressing Social Security is considered a no-win, and, it's hard to get attention, but the problem is coming. It's not going to go away. It's not self-correcting. So, okay, that's enough of that. I've said my piece. Just a couple of closing things. Keep an eye on the foundation site, the Social Security report, for example. The foundation site for upcoming events and our Monday morning blog, Social Security report to keep update on things that are happening in Social Security, and the Medicare report just to keep abreast of breaking news. And if you know of anybody that needs Social Security information or has questions, please contact our advisory service. There's the telephone number, and you can send us an email. Or if you're close enough, you can just give us a call and walk in. We'll be happy to chat with you. That really ends our session. So, are there any questions? Or is your brain completely full? Pardon me? Yes, we can get you a copy, no problem. Yeah. So, any questions at all? We have the experts. This is your opportunity. Yes, ma'am.
I was the executor for my parents, and it was very confusing when they died because I heard mixed things. If they died in the middle of the month, let's say my dad, that his benefit that was already paid for that month could be rescinded by Social Security, or pulled back or whatever from the bank. It didn't happen, but do they have the option of waiting a year or two and then doing it? I've always left that buffer in the bank until.
Correct, yeah. What happens with a lot of Social Security benefits upon the death of an individual, if your benefit is direct deposited into a bank, okay, the funeral directors, many of these folks around the country are connected, their systems now are connected with federal records. So as soon as a report is made, that report is made to federal records, and those Social Security benefits are cut off very quickly. If the check, the timing of checks, of course, okay, so let's say you're getting a check on the second Wednesday of the month, the person dies, let's say, on that very day, and so the bank will send the bank will receive a reclamation from Treasury to send that money back, especially if the check, let's say the check was paid the day before they died, for instance. It would be just like me giving you a paper check the day after you died. Can you sign it? You can't. You've passed away. Treasury reclaims that immediately from the bank. It's unfortunate because a surviving spouse is sometimes left still having to pay bills. So Social Security does have a process. The check is still due the surviving spouse because the check represents the month prior, and the person did live the entire month. So the check is due to now the estate or to whoever falls in the list of priority. So there is a form that an individual must complete. Basically, the spouse completes. It's very simple, submits it to Social Security, and then they basically get it to the powers that be at the program service centers to cut a check from Treasury. Can it take a little bit of time? Yeah, it can. That's the unfortunate part. Can the person rush to the bank and take the money out? Yes, they can. The problem is that the bank has to honor a reclamation from Treasury. They have no choice. So you take that money out, the account is at zero, you're going to get a call from the bank saying you're in a deficit because they have to send that money back to Treasury. Okay. Does that answer the question? Thank you.
That you don't get Social Security for the month that you die. Your estate doesn't, because you haven't lived the whole month. You have to live the whole month, as Ken said.
Thank you. Great question. Actually, that happens a lot.